When we look at Bitcoin, we see something that few assets in human history have demonstrated: survival under pressure. Regulatory reversals, macroeconomic shock waves, institutional skepticism. Bitcoin has faced all these and yet it remains. That's not just luck. That speaks to a foundation built on technology, trust, decentralization, and an idea whose time is now coming. When I look at the global financial landscape today, I see a system built on a single assumption: that one currency can anchor the world. It's an assumption that once worked, but like all concentrated systems, it's showing fractures. The events of the past few years have exposed how fragile reliance on one monetary power can be. The world moves faster now. Technology moves faster. Capital moves faster. But our mindset toward money remains stuck in a past that can't sustain the future. We've entered a period of radical transformation. The instruments of finance, the velocity of information, and the balance of geopolitical power are all shifting simultaneously. In such an environment, trusting a single currency to store value, transact value, and preserve purchasing power is not just risky, it's short-sighted. Economies are diversifying, trade corridors are evolving, and digital networks are dissolving old barriers. When systems change this dramatically, concentration becomes fragility. We've seen this before. History repeats through different symbols, but the lesson remains the same: concentration breeds collapse. A single empire's currency once dictated global trade, then another replaced it, only to face the same destiny. Each time, those who diversified early didn't just survive the transition, they prospered from it. The same principle applies now. The old monetary framework is reaching its limits, not because of failure, but because of evolution. We are being pulled toward a more distributed, more digital, more inclusive structure of value. This is not a moment of fear, it's a moment of awakening. The future will belong to those who think beyond one medium of exchange, who understand that money is no longer a static institution, but a dynamic ecosystem. As capital becomes code, as trust becomes programmable, we will see a world where multiple assets coexist, complement, and compete in a free marketplace of value. The ones who adapt will not only preserve wealth, but multiply it through understanding rather than speculation. Relying on one currency is like building your house on a single pillar. It may stand strong for a while, but the forces of time and change are inevitable. The global economy is rebalancing. Emerging markets are asserting themselves, technology is democratizing finance, and innovation is rewriting the rules of monetary trust. The next era of growth will reward flexibility, adaptability, and conviction grounded in understanding, not in nostalgia for how things used to be. So yes, the storm has passed, but the winds of change have not stopped blowing. Those who still anchor their fortunes to one source, one system, one narrative, will feel the tremors of transformation the hardest. The world is telling us to evolve. The question is whether we're willing to listen. Because the future of money will not belong to the dominant, it will belong to the diverse. In times of transition, when uncertainty clouds every forecast and noise overwhelms reason, the most powerful strategy is to return to what is real. Real assets, real innovation, real value creation. These are the foundations that endure when everything else fluctuates. The world has spent years building layers of abstraction derivatives, synthetic instruments, virtual credits, and algorithmic liquidity, yet beneath that complexity the principle remains timeless. True wealth rests on tangible creation, not on illusions of value. The past few decades rewarded those who mastered leverage and speculation, but that age is closing. The next cycle belongs to those who understand substance. We're seeing a rotation from financial engineering to productive innovation, from paper gains to structural progress. When you own something real, whether that's a breakthrough technology, intellectual property, land, or infrastructure that improves lives, you hold a piece of the future, not a fragment of passing sentiment. Real things generate real impact, and that's where compounding truly begins. The most successful investors of tomorrow will be those who look beyond volatility and into utility. When fear dominates, liquidity flees to the safest assets, but when the world rebuilds, capital flows to the most useful ones. We're living through an inflection point, where what is useful, measurable, and transformative will outlast what is purely speculative. The lesson is simple: the closer your portfolio is to reality, the more durable your wealth becomes. Owning real things is not about nostalgia for the physical world, it's about recognizing enduring value in a digital age. A company that solves an energy bottleneck, a network that decentralizes trust, a technology that democratizes access. These are the new, real assets. They may exist in code or hardware, but they produce tangible outcomes. Innovation itself is becoming a form of hard asset, and its scarcity will only increase as breakthroughs accelerate. When the noise quiets, what remains are fundamentals. Real value can be measured in the problems solved, the efficiencies created, the progress enabled. That's why those who build, rather than merely trade, will shape the next financial era. The world rewards patience in ownership, not the speed of speculation. Every disruptive phase in history, industrial, digital, or biological, has reminded us of this truth. The creators, the innovators, the long-term owners are the ones who reshape the world's wealth distribution. As cycles turn and narratives shift, remember that perception can inflate prices, but only reality sustains them. The future is being rebuilt on authenticity, in resources, in ideas, in technology, and in trust. When you own what's real, you are not chasing momentum, you are anchoring yourself in progress. And progress, once set in motion, compounds beyond imagination. The markets may rise and fall, but value rooted in real creation will always find its way back to the surface. In a world that moves faster every year, where innovation accelerates and markets fluctuate with unprecedented speed, one principle remains as relevant as ever: spreading your risk is not just smart, it is essential. Concentration, no matter how tempting, exposes you to shocks you cannot predict. True resilience comes from balance, from positioning yourself across multiple dimensions, so that no single event can dismantle your progress. Diversification is not about scattering resources indiscriminately. It is about thoughtful allocation across ideas, technologies, geographies, and strategies. Each component is chosen for its potential to contribute to the whole, to offset volatility, and to participate in long-term growth. History shows repeatedly that those who relied on a single market, sector, or asset class were the first to feel the pain when conditions changed. Those who embraced breadth, however, were the ones who could endure turbulence and seize opportunity when it appeared. This is particularly true in periods of transformation. The past decades have demonstrated how quickly old paradigms can crumble. Entire industries can be disrupted almost overnight. Currency systems can face pressure. Regulatory landscapes can shift. In such an environment, protection comes not from prediction but from structure. By diversifying across multiple vectors, you reduce the impact of any single failure while preserving exposure to multiple paths of growth. Yet diversification is more than a shield, it is a lens for opportunity. When you explore multiple sectors, you see connections others miss. You can combine insights from technology with shifts in energy, from global demographics with emerging digital networks. A well-diversified approach allows you to capture asymmetries in the market, to participate in growth wherever it occurs, and to transform uncertainty into advantage. It's not about avoiding risk entirely, it's about managing it intelligently. The mindset behind diversification requires patience and conviction. It is not reactive, it is proactive. It is understanding that value emerges over time, often from unexpected sources. When you structure your exposure thoughtfully, volatility becomes a companion, not a threat. Each rise and fall across your holdings balances the other, smoothing the path and allowing your focus to remain on the long horizon rather than short-term noise. Ultimately, protection through diversification is about durability. It is about creating a portfolio, a strategy, and a perspective that can survive storms and capture growth simultaneously. Those who master this principle do not just weather uncertainty, they thrive in it. They understand that the world is complex, that cycles will continue to turn, and that the wisest approach is one that embraces breadth, insight, and resilience. In a rapidly changing world, this is not merely prudent, it is essential. It is the framework that allows vision to meet reality and opportunity to meet preparation. In every market, in every innovation, and in every economy, Cycles are the invisible currents beneath the surface. They are not always apparent in the noise of daily fluctuations, but they dictate the shape of opportunity over years and decades. The challenge, and the reward, lies in recognizing that real transformation is never linear. Peaks and valleys, booms and corrections, optimism and skepticism, they are all part of a rhythm that has repeated across industries and generations. To succeed, one must align with these rhythms, not against them. When we observe history, patterns emerge. Technology, finance, and human behavior move in waves. Early adopters often face extreme volatility, skeptics hesitate, and the mainstream adopts only when the tipping point has arrived. It's in these long-term cycles that the seeds of extraordinary value are planted. Those who focus only on short-term gains miss the broader trajectory. The first principle is patience. The next is perspective. Time amplifies insight. Innovation itself is cyclical. Disruptive technologies do not succeed overnight. They begin in laboratories, in small ventures, in corners of the market that seem marginal. Adoption is slow at first. Skepticism dominates. Capital hesitates. Then, gradually, adoption grows geometrically, tipping industries and shifting global norms. Those who enter too late see only inflated prices. Those who exit too early experience regret. Recognizing the full cycle allows one to endure volatility and remain positioned for transformative growth. Cycles also manifest in the economy at large. Credit expansions, regulatory shifts, demographic changes, and geopolitical forces ebb and flow over decades. Investors and innovators who ignore these larger patterns find themselves caught off guard. They interpret short-term movements as permanent, reacting impulsively rather than strategically. Those who understand cycles prepare. They position themselves to benefit from structural trends, not just temporary sentiment. They see downturns as opportunities to deepen exposure, to acquire assets that will generate compounding growth as the next phase unfolds. The principle of compounding is inseparable from long-term cycles. Just as technologies mature over decades, capital deployed with patience grows exponentially. Short-term noise is misleading. Temporary setbacks are not failures but recalibrations within a broader progression. For example, a company pioneering a new energy source may experience regulatory hurdles or market skepticism for years. Yet, when adoption accelerates, the compounding of earlier investments creates outsized returns that are invisible to those focused on quarterly results. Recognizing cycles allows one to ride these transformations rather than being swept away by them. Behavioral patterns reinforce cycles. Human psychology, collective sentiment, and herd behavior create exaggerated peaks and troughs. Markets swing from euphoric optimism to profound fear, often disconnected from underlying fundamentals. The discipline of long-term thinking requires resisting these extremes, understanding that temporary panic is often opportunity, and that excessive excitement can precede correction. Those who master their own psychology in the context of cycles maintain clarity when others are clouded by emotion. Furthermore, cycles are interconnected. Technology drives productivity, which shapes economic cycles. Demographics influence adoption curves. Geopolitical shifts reshape trade and finance. Viewing cycles in isolation provides only partial insight. To truly align with long-term transformation, one must integrate these elements, recognizing how they amplify or dampen one another. This holistic perspective allows strategic positioning not only for individual investments, but for participation in broader systemic change. Finally, long-term cycles reward vision over reaction. They favor those who think in terms of decades, not days, who value innovation, resilience, and adaptability over transient sentiment. The world is transforming at unprecedented speed, yet the same principles that guided the most transformative investors remain valid. Understand the rhythm, endure the volatility, capitalize on structural trends, and above all, remain patient. Those who do not chase the immediate but embrace the horizon will find themselves not merely surviving, but thriving in the eras that follow. Time is the ultimate arbiter of value. Short-term fluctuations are noise, long-term cycles are signal. Aligning with them requires insight, courage, and discipline. Those who can perceive the shape of decades, rather than the twitch of days, are the ones who will capture the true promise of innovation, capital, and human ingenuity. Patience, perspective, and a deep respect for cycles transform uncertainty into opportunity. By thinking in terms of long-term cycles, one is not simply investing or observing, one is participating in the ongoing story of progress itself.